I feel like one of the most practical and common man ways to track what's really happening in our economy today is to take a look at what the delinquency rates are on all different forms of debt. And I'm going to put up a chart here pretty soon that shows exactly those figures. And I used this same chart a few months ago. I was looking for it in my past videos, but I make so many videos, guys, I couldn't remember which one it was in. But basically, when you look at this chart, you will see that delinquencies on almost every single form of debt are really going up right now in a really meaningful way. In fact, the only one that's not really ticking up, at least not yet, is student loans. I mean, that one is still remaining very low and pretty flat. But when we take a look at this chart, everything is skyrocketing right now, particularly the worst ones, you know, credit card debt and auto loans. These two are like the big stars right now when it comes to delinquencies. And you can see how much things have changed because this tracks what it was like a year ago in the first quarter of 2022, 2021, etc., going all the way back to the first quarter of 2003. And while the delinquency levels might have been higher back then, that's not what I'm paying attention to. I'm paying attention to how fast these delinquency rates are going up right now. Credit card debt, it is about 9% right now, and the auto loans is hovering right at 8%. And just going back a couple of years ago, these numbers were, you know, below 5%, guys. So that is a major increase in just the last couple of years. And if you look towards the bottom of this chart, the yellow line, those are mortgage delinquencies. And you can see those were obviously extremely high during the housing crash we had back in 2007, 2008, 2009, and steadily came down afterwards. But what do you notice? It is rising back up. So as far as I'm concerned, you know, we can hear all the feel-good stories that they want to tell us about how great things are, but this chart really just tells it the real picture of what's going on. This shows you how many people are in distress, and you know, 8 or 9% of anything might not sound like a lot, but that translates into millions of people who are not paying their bills, guys. And the delinquencies is like the first sign that the consumer is starting to crack, right? That people are just not able to come up with enough cash each month to make ends meet. We've covered some other things earlier in the week, like the retail sales remaining flat, and it was supposed to go up, which means that people are essentially spending less money and buying fewer things, or just spending more money on the things that they have to buy right now. And just on May 10th, we saw a 13% drop in the consumer sentiment survey, guys. So people are feeling worse and worse about where things are going right now. And I think it's largely because people are finally starting to feel this in their wallets. You know, people are finally feeling the full impact of the higher interest rates and higher inflation. And you know, gone are the days where you might be able to put a few things here and there on the credit card to get by. Now it's putting everything on the credit card to get by because your entire paycheck is going towards just paying the rent and eating. Something else that we've talked about time and time again is how the savings rate has been consistently depleted over the past couple of years and now is at one of the lowest rates ever. And guess what? All of these delinquencies and people not doing so good with finances right now is going to have an impact on securitized bonds. Now, all this spells trouble for bond funds that own securitized debt backed by payments owed on consumer debt, okay? Things like credit cards, auto loans, student loans, and home mortgages, they bundle all this up into bonds these days that investors buy. We have this massive debt-based economy that even people invest in other people's debt. You know, that's how insane things are today. And these bonds that investors buy typically do better during these high inflationary periods when traditional bonds fall in price when the rates go up. So for right now, one of these income funds, you can get about a 6.7% yield, but they're worried about what's happening with the state of consumer credit right now, guys. Like, they're investing in this, and if these defaults and delinquencies continue to rise, those bonds are going to become worthless. The funny thing is the guys who are in charge of these funds, they say, we're taking a look at the delinquencies, but that's not even what worries us. What worries us is the spread in terms of what these bonds are yielding versus a risk-free treasury, you know, because right now you can invest in a 3-month treasury and get about 5.6%. So you're not really doing much better investing in this much higher risk asset at 6.7%. I know I certainly wouldn't be doing that. And the yields on these bonds are crashing big time, because at the end of 2022, you could get a subprime auto loan rated BB, which would yield you around 12%. And now it's only about 8%. Which investors love getting these higher returns, but also those higher returns come with much higher risk. Obviously, subprime auto loans, I mean, come on, guys. The delinquencies on these auto loans are literally going through the roof, you know? You can see it on the chart that I showed you a few minutes ago. But you know, people are lured in by these high returns, and it's just like that old saying goes, you know, if it looks too good to be true, then it probably is. So if you're getting a big return off of something, there's a good chance that there's a high amount of leverage and risk involved in that investment, and you stand to lose even bigger than what you're gaining. And I'm not on here giving you investment advice. I don't care what you do. You can do whatever you want, guys. I prefer the safer investments. I prefer getting a lower rate of return on anything and knowing I'm going to get that money each month versus getting a higher return and possibly losing my entire investment, or at least a significant portion of it. Now, the other day I talked about Amazon and how they have laid off a tremendous amount of people this year. I think year to date, it's over 27,000 people they have let go. Well, on top of that, it's not even that great of a place to work, because 5 years ago, they raised their wages to $15 an hour, okay? And they surveyed a bunch of the warehouse workers they have over there, and half of them say that they can't afford food or a place to live working at Amazon. There was a survey done by the University of Illinois, Chicago. They asked U.S. employees about their economic well-being, including whether they'd skipped meals, went hungry, or were worried about being able to make rent or mortgage payments. And 53% of these people said that they experienced one or more forms of food insecurity in the prior 3 months, and 48% experienced one or more forms of housing insecurity. And workers who said they took unpaid time off after getting hurt on the job were more likely to report trouble paying their bills. But right away, the Amazon spokesperson, Steve Kelly, said that this methodology is deeply flawed and it ignores the best practices for surveys. They have limited verification safeguards to confirm that any of these people actually work at Amazon, you know, just trying to deny all of this, like if it's some kind of affair. And he also said that Amazon has since increased their hourly pay to $20.50 an hour, and they provide a range of benefits including healthcare, dental, 401k, and paid tuition. I don't know about you guys, but if I worked at one of these places, I haven't had a regular job since I was 21, so I'm out of the loop with that kind of stuff. But if I worked at a regular job and I saw, okay, they have these list of benefits plus $20 an hour, I feel like they should give people the option, like, hey, I don't really want all these benefits. I'd rather get paid an extra $5 or $6 an hour, whatever it costs you guys to contribute to my 401k or give me dental or health insurance and all this stuff. I would rather just get the maximum amount of pay possible and do with that money what I will, you know, and budget myself accordingly, rather than have the company pay me a little bit less but give me all those benefits. That's just my outlook on it, on how I would want to be paid. You know, for a long time, Amazon has been in trouble for the treatment of their employees in their warehouse, on how many hours they make them work and the type of injuries they end up getting, and not really helping them out in that department. So 1/3 of these people working at Amazon said that they're turning to living off the government, like food stamps or Medicaid, and this is all in the last 3 months. And they even found that Amazon was one of the biggest employers in the country with people who receive food assistance. According to this story, Amazon's median U.S. employee makes about $45,000 a year as of 2023, which the year before was $41,762. So they did get about a $4,000 a year raise. And they also say that people who work in transportation make more than the $20.50, but most of the people at Amazon make anywhere between $16 and $20 an hour. And you know what the sad part is here? 65% of the Amazon workers say they actually make more money there than they did at their previous employer, and it's still not enough money according to many of them. And they also say it's very hard to get a promotion at Amazon. Only 13% of the survey respondents said they received a promotion during their time working at the company. And then after hearing all this, you can say, well, Michael, this is exactly why we need to have the student loan forgiveness and all these subsidies and welfare, because people need help, right? Well, they're listening for sure, because the Biden administration just extended some of the key deadlines for student loan forgiveness, okay? They have the chance to get their loans consolidated. Previously, the deadline was April 30th. Now they're pushing it out to June 30th. And through this consolidation, they get into a new federal loan, but they can get their debt canceled sooner than they would have otherwise if they don't consolidate. And some people are even seeing their debt forgiven immediately now on this. And I'm not going to get into how fair all this stuff is, or really how unfair it is, guys, because I've already talked about that in previous videos. I just want to make it a point that this is something that is happening. There are people all across the country that are getting a big chunk of their student debt canceled still, even though this was ruled to be unconstitutional by the Supreme Court. So they say that this consolidation of student loans really benefits people who have been paying off student loans for many years, and they go ahead and do this, and especially if they have multiple loans, and now all of those loans, if consolidated, could be forgiven sooner than later. But it seems like the government doesn't know what they want to do. Like, you know, this was kind of on purpose, that the student loan debt is one of the biggest assets that the government has. I think it still is the biggest one. And now they're trying to forgive a lot of it, but at the same time, the interest rates on these student loans are going up. It's like one of those situations, like we're saying we're gonna help you and forgive your debt, but at the same time, if you're still paying debt, then your interest rate's gonna go up, which obviously is gonna make it harder to pay and will end up making you pay more in the end. So right now, federal direct undergraduate loan rate will be 6.53%, up from the previous 5.5%. Okay, and this is the highest it's been in 16 years. So far, the Biden administration has canceled $146 billion in debt through a bunch of different programs, even though the Supreme Court blocked this because they wanted to do a blanket $400 billion student loan relief program. That got blocked. They've still been able to get away with forgiving almost $150 billion in student loans despite this. And they say that the new rate for direct unsubsidized loans for graduate and professional students is 8.08% for the next academic year, and the previous year it was 7.05%, guys. So this is another example of the lag effect moving throughout the economy. Even when it comes to taking out debt and borrowing money to go to college, this should start making more and more young people think twice if you really should be doing this right now, because you're going to be on the hook for paying this back. Or they kind of tease that maybe you will, maybe you won't, since some people get student loan forgiveness and others don't. And then direct plus loans for parents of dependent and undergraduate students, okay, their interest rates are going up to 9.08%, which is up from 8.05%. That's the highest increase they've seen in 24 years. And now the rate itself, being over 9%, is the highest it's been in over 33 years. So you can argue to say that this is probably the worst time to go to college in the past 30 or 40 years right now. And all of these interest rates for all of these student loans are all based around the 10-year Treasury, which has been hovering very close to that 5% rate again. And then of course all the people who are involved with this say, oh, don't worry about it, because you know, on a $10,000 loan with a 10-year repayment plan, the new rates would only add about $5 or $5.50 to the typical monthly payment. And they also say that many people take out loans that are smaller than $10,000. Here we have a house for rent for $7,500 a month, and this person has been trying to rent this house since November of 2023 for $8,500 on and off, and then they lower the price, put it back on the market again, lower the price again, and still no rental. But guess what? This person needs to rent this house desperately because they are 3 years behind on their property taxes. That's right, guys. 3 years behind, as you can see, as per the county tax roll here. And that's just their property taxes. We don't know how much they owe on insurance, how much they have to pay each month for their mortgage, anything like that. And this is what people who have never been a landlord don't understand.
They can't even rent this house for $7,500 a month. It doesn't matter if their expenses are $9,000 or $10,000 a month. They can't raise the rent higher just because their expenses are higher, because they already can't get the $7,500 a month. How on earth are you supposed to raise the rent to $10,000 a month to cover your expenses? So this is what happens when you get in trouble financially with a house, and really their probably only real viable option with this house is to just sell it and get rid of it, but they're probably trying to hang on to it and rent it first and see if that works out. But if they don't rent this house soon, they could lose their house to the county for not paying the taxes.
They say that all this doesn't affect people who get student loans through private lenders, because obviously they make their own rates and they base your interest rate on your credit score and your income and everything else. This is just yet another sector of the economy that is going to be hit by having these interest rates higher for longer, guys. And like I've said before many times, the rates aren't really high enough to do their job yet. You know, if people are still going out and borrowing money to go to college even though the rates are going up, well, then it hasn't really done its job as far as I'm concerned. I'm not saying people shouldn't go to college if you really need to for your profession or something you've always wanted to do, but if you can get a decent job without going to college right now and make a good living, that might be the better bet for a lot of people. I mean, let's face it, it's already hard enough to survive in an economy where inflation and debt and delinquencies are spiraling out of control. And to make matters worse, you're going to go to school and get yourself into even more debt and make that problem worse for yourself. So even high income earners that go to school for something like being a doctor or a lawyer, if you're graduating with hundreds of thousands of dollars in debt, how many years is that going to take you to pay off that? Especially when interest rates haven't been this high in 30 years. And I know this isn't something that students typically pay attention to, and probably don't have a lot of potential students watching this YouTube channel, but I'm sure a lot of their parents are watching, or their grandparents or uncles or aunts, and you know, you can kind of give a heads up on this if you have a young one that is thinking about going to college soon and getting into massive debt for it. And to me, the worst part about this is it just already sets up these young people for failure, guys, because one thing I talk about here all the time on the channel is if you want to be healthy financially, you need to get yourself out of debt. And right away, without even getting a job or ever having a real start in life, they want to saddle you with tens of thousands of dollars in debt to go to school. It's not right. And let's face it, when you're 17, 18 years old, you don't really have the mental capacity or any sort of financial experience to make a well-informed decision if that's really a good idea for you or not. So I think it's up to the parents and relatives, people that they know, to give them some guidance on this who do have that experience. Anyways, as you can see, I've been trying to walk in the shade as much as possible, guys. We got hit with this heat wave that started last week, and I thought it was only going to be 1 week, and it's just never ending. It's just continuing to go on. Like every day feels like over 100 degrees here. It is absolutely crazy, and I'm counting the days until I'm out of here. It's about 2 weeks from now I'm gonna be leaving South Florida for the summer, and I can't wait. This is literally the hottest place in the country right now when you look at this weather map here. So if you're not here, consider yourself lucky. Unless you're in Texas or Arizona, you're feeling the heat too. So if you guys enjoyed this video, make sure to subscribe to the channel, and if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.